The Gordon growth model is a method used to determine the intrinsic value of a stock based on the concept of present value. The model takes into account the current dividend, the expected dividend growth rate, and the investor's required rate of return to calculate the stock's fair value. To use the Gordon growth model, for stock valuation, you first need to gather some key pieces of information. These include the current annual dividend payment of the stock, the expected annual dividend growth rate, and the investor's required rate of return. The current annual dividend payment is typically easy to find, as it is listed on most finance websites and stock market platforms. The expected annual dividend growth rate may require some research and analysis of the company's historical dividend growth and future earnings prospects. Lastly, the investor's required rate of return can vary based on individual risk tolerance and market conditions. Once you have the necessary information, you can plug it into the Gordon growth model formula for Ocker D SAS R G, where V is the fair value of the stock, D is the current annual dividend payment, R is the investor's required rate of return, and G is the expected annual dividend growth rate. By using this formula, you can calculate the fair value of the stock based on the present value of its future dividends. If the calculated fair value is higher than the current market price of the stock, it may be considered undervalued and a potential investment opportunity. On the other hand, if the fair value is lower than the current market price, the stock may be overvalued, and it might not be a good investment at that price. It's important to note that the Gordon growth model is based on certain assumptions that may not always hold true in the real world. For example, the model assumes a constant dividend growth rate, which may not be the case for many companies. Additionally, it assumes that the investor's required rate of return accurately reflects the stock's risk and return potential. As with any financial model, the Gordon growth model should be used as a tool for valuation rather than a definitive answer. It is just one of many methods used by investors and analysts to assess the fair value of a stock. It's important to consider other factors such as company fundamentals, industry trends, and market conditions when making investment decisions. In conclusion, the Gordon growth model is a useful tool for stock valuation that takes into account the present value of future dividends. By gathering the necessary information and plugging it into the formula, investors can calculate the fair value of a stock and make more informed investment decisions. However, it's crucial to remember that the model is based on certain assumptions and should be used in conjunction with other methods and considerations when evaluating potential investments.